Hello, everyone, and welcome to Finance and JCL, the show aimed at beginner and intermediate level investors. And a warm welcome to you if you're joining the show for the first time. So today's episode is an update on the 1 million challenge, and it's my July 2020 update. So the objective for today is to refresh you on what the 1 million challenge is, share my progress, and it kind of gives you an interesting opportunity to follow me on my journey. So I'm not saying necessarily copy what I'm doing, but it gives you an idea to see the mistakes I make, but also see the really good purchases I make. It'll get you thinking about investing and how you want to invest in the long term. So as a refresher of the plan, you see the graph on the left. Over the next 40 years, the orange value is what I want my portfolio to do. So you can see that growth pattern just increasing as time goes on, and that's the compounding effect. The minimum annual return that I want is 6.66%. And that's broadly sort of the stock market long-term average. I think that's a relatively conservative goal. I think it's relatively achievable. And the key message I'm going to be repeating to myself as I go through this is it's very much a long-term investing, so don't be worried about day-to-day, month-to-month, year-to-year fluctuations. I'm looking at companies and funds with that very long-term approach in mind. And whenever I buy particular individual companies, I will buy them with a margin of safety, and that enables me to hit rule 1 of investing, which is don't lose money. So that's a refresh of the plan. So this is the first update since I launched the plan. And this is where I'm at so far. So the end of year target for 2020 is to have 24,932 in this element of my portfolio. And the current value is 24,155. So there's a small shortfall there of around about 800. However, based on the money that I'm putting into this, there's going to be another 1,500 of deposits before the end of the year. So if you add that to the current value, sort of tracking for 25.5, so should be ahead of target at the end of the year, notwithstanding any particular market fluctuations. So we're pretty happy with that. It looks pretty good. So in terms of how the portfolio is split for this particular element, I've got it split between two instruments, and they're both tax efficient. So one is an ISA and the other is a personal pension. And for those of you that are watching and listening from outside the UK, an ISA is an individual savings account. It's a tax-free account that someone can put up to 20,000 a year into, and they pay no tax on the capital gains or any withdrawals from that investment mechanism. And with pensions in the UK, the government will give you some tax relief against what you invest in the pensions. So there's good tax efficiencies for both of these accounts. So with the ISA first, which is where the majority of that money sits, 7% of the portfolio is in bonds, and that hasn't changed since last month when the challenge was launched. And the amount in bonds is going to be quite low for me as I go forward, and the thought process behind that is bonds are much more steady and they give much more known returns, but the rate of return is lower. So they're a good way for kind of steadying out the portfolio, and as one gets older, the conventional wisdom is that one should increase the amount of bonds in their portfolio, especially as they get near retirement, as it reduces the volatility or the price fluctuation in their portfolio. Now that's not really an issue for younger investors, but for those that may wish to actually take chunks out of it, the bond is an important instrument. So it's pretty low in my portfolio, and the funds I've got are up between 30 and 40% in bonds in sort of 5 to 6 years. So they're doing quite nicely. Now, index trackers is the next one, and that's 22%. That's broadly similar to last month. And the index tracker element I want to be increasing over time, up to perhaps 30 to 40%, but no more than that. And for me, index trackers, when there's a lot of time on your side, they're fantastic. You can chip away at 6 or 7% a year with an index tracker. And over 40 years, over a very long period of time, which this challenge is, that will compound very, very effectively with very low costs and very low risk of making a mistake. So that's why the pension's pretty much all in index trackers, because that can't be touched for 30 years. even longer. And the ISA, what I'm doing each month, the amount of monthly money I'm putting in, over half of it goes into cash at the moment, and then sort of a portion of it's probably between 30 and 40% goes into index trackers. My index trackers are spread around a couple of different funds. So some of it's in the UK, some of it's in America, and some of it's sort of the Asian area. So that will keep ticking along, and the rest of money goes into cash, and it will get deployed out of cash once I find those very wonderful individual companies to invest in. But I won't invest until I find those companies at the right price. So that brings us nicely into the individual company section. So again, that's broadly similar, 36% of my ISA portfolio. And that's increased a bit this year as I've learnt more about valuations and investing. But I'm really struggling with the companies that I found are outstanding to actually find the right price with that margin of safety. So rather than just buying them and taking a bigger risk, I will sit back, I'll wait until the companies on my wish list have some kind of event or a price drop, and once that margin of safety of at least 50% is reached, I will then buy them. So I've got over 10 on my wish list. I'm just waiting for those prices to drop. Now, that also links to why a market crash can be an opportunity, and I've got a video on that subject, which helps explain my thinking around that in a bit more detail. So moving on to managed funds. Now, managed funds isn't something I necessarily go heavily into if I was starting out, but I've had some legacy managed funds that I've had in my portfolio for several years. And you can see here I've trimmed that position quite significantly. So it was 22% of my portfolio, and in the space of a month it's gone down to 16%. I've been doing a lot of research on funds that I have, and the one that I sold we'll come on to a bit later, but it had a very large fee, and although it's performing well, the performance could have been better if that fee wasn't so large. So I've ditched that fund and put that money into cash, and it's just waiting. I'm just waiting for the opportunity for a wonderful company to come on sale with a margin of safety. And finally, we have commodities. Now, I do have a very small speculative element to the portfolio, which is, I guess, a form of gambling in some respect, because I'm not looking at something that produces an output. I'm looking at the commodities, which is I'm buying something and I'm betting that someone will pay more for it at a later date. So hands up here, that isn't investing, that is speculating, which is why I've limited it to such a small part of the portfolio. So it was 1% last month, but the values have increased. So that's actually up to 2% of the portfolio now. But I want to keep a very small slice of that portfolio, certainly never more than 5%, and ideally less, for that kind of speculative element. Now, it's not investing, but I'm aware of that, and I'm very careful in what I'm looking at in that commodities section. So pension-wise, as mentioned, it's pretty much all in index trackers, and then there's just a bit of cash there as well. And the pension thing is likely to stay in index trackers just to keep that long-term safe compounding, and it should build up nicely over a very long period of time. So that's a portfolio, my thinking around it. Hopefully that gave you a bit of insight into, if you're constructing your own portfolio for your own individual circumstances, the sort of questions you may wish to ask yourself. Cool, so the key changes here, since last month, I've integrated a new tracker into the portfolio, index tracker. So what I'm saying here is I want to look at the Pacific region, excluding Japan, and I want to be tied to the fortunes of the stock market and companies in that area. I've kind of got less exposure than I used to that area. I want to just diversify the indexes away from just the UK, which is probably where I was a couple of years ago. So that's why that one's come in. I've actually sold a fund, and I mentioned that mutual fund I've sold, which is the Jupiter Merlin Growth Portfolio. Now, you're probably thinking I'm a little bit nuts here. You might be right, but I'm up 127% on that fund. I've had it since 2009. It's the very first proper investment I made, and up 127% is absolutely fantastic, and it's outperformed the UK market. So first glance, that's pretty cool, but actually the fee on that is 2%. So actually that growth could have been a lot higher, and one of the rules of investing I'm putting on myself is I'm not going to invest in any new mutual funds anyway, but for funds I do have, the fees have to be around about 0.5% or less. They've got to be low fees because it's just eating away that return otherwise. And I'm going to do a video on this fund in much more detail because, in fact, although it massively overperformed the UK market, it actually underperformed the US market. So I would have been better off having a US tracker, which is why I've sold this. And I'm just waiting with that cash for the right time to reinvest into something else. And as I've alluded to on the previous discussion, I haven't bought any new company shares. So I haven't found that wonderful business with a margin of safety in its price. So I have found wonderful businesses, but I can't buy them yet. So no new shares purchased. And that's going to be the norm for most months, unless there's a market event or a crash. I'm not expecting a high level of transactions now. My company portfolio is more settled, and the transactions will only happen when those companies are available at a cracking price. So I hope you found that video useful. We've had a chat around a bit of what my portfolio looks like, how I'm doing against the challenge, and it's all on track so far. I'm looking for that kind of opportunity to buy when things come at the right price. If you found all these discussions insightful, useful, please hit that like button and it will improve the standing of the video in the YouTube algorithm. And I'm very much in favour of that, of course. And you can further support my work here by subscribing to the channel, and you'll be alerted to when the next show comes on. So I really hope you can do that for me. So in closing, I'd like to thank you for joining me today, and I look forward to you joining me next time.